By the time we got to 2008, the debt side of the equation was literally ridiculous. Every major economy was pretty close or above 100% of GDP in debt at government level. Households were at record high debts. Corporations were at record high debts. And then the world stopped. You see, what happened in 2008 was the value of the collateral of the system started falling. And that was when the equity market starts falling. The real estate market was the real one. That was huge amounts of collateral with massive amounts of borrowing. The collateral falls, the borrowing becomes unsustainable, the whole system imploded. Now, the banking system itself was record leveraged. And what happened was this complete meltdown of the global financial system.
We're down over 16%. Dow at the same time has fallen about 18%.
Sounding the alarm about the rising national debt that can reach $141 trillion by 2054.
As expected, the Federal Reserve not doing anything on interest rates.
In this interview, Real Vision's CEO and billionaire investor Raoul Pal discusses the 2008 financial collapse. He provides insight into what happened exactly and what it means going forward. He explains that after 2008, we all became debt slaves as the price of preventing a 1929-style crash. This price takes the form of the debasement of currency that has become a key pillar of today's global economy. He provides a detailed framework for understanding this problem and reveals how the increase in life expectancy and the baby boom of the 1950s led to 2008. Raoul also exposes the shocking reality that investing in traditional assets like real estate and stocks are currently losing you money, even if your fiat value is optically increasing. This might sound ludicrous, but Raoul's detailed analysis provides a thorough explanation of why it seems like nobody is getting richer with the upcoming election and expectation of Fed dropping interest rates. Raoul thinks we're about to experience 2008 again. Let's dive in to hear it all.
The first instance is debt, demographics, and deflation. This is the thing that shapes our world. We're driven by demographic forces, and they're baked in the cake. Populations grow, populations shrink. The population of the Western world has been shrinking or has been declining in growth rates for a period of time. There are some countries with different demographics, and I've talked about that before. Why India, the Middle East, and other countries are maybe a better investment opportunity than the West in many regards. But you see, the whole thing came about from the debt demographic and deflation understanding of the world. You see, the older the population is and the more debts that they have, the slower the trend rate of GDP growth is. And that's what creates enormous problems. And I'm trying to deal with that and let you understand what that kind of means. After World War II, we had a record amount of people born in the Western world. Those people, their journey is the story of our economy. The growth go-go years of the 50s and 60s. The inflation of the 70s driven by all of these people coming into the workforce, earning an income and competing for goods and services. Then the 80s and 90s. The 80s was them financializing. They get to their 30s and they start buying financial assets. That starts moving the price of assets. By the time we get to the 90s, we start to bring other people into this global labor force. So not only have we got a record number of people competing for jobs, but we also then bring the WTO agreement and we start bringing everybody from China to Mexico to Vietnam into the labor force. That means that wages never really went up in real terms. Yet, because people are investing in their 401ks, assets were going up. So that was the start of the great asset unbalance. What happened was, over that period of time, people started taking on more and more debt to fund the difference in the asset price rises versus their wages. By the time we got to 2008, the debt side of the equation was literally ridiculous. Every major economy was pretty close or above 100% of GDP in debt at government level. Households were at record high debts. Corporations were at record high debts. And then the world stopped. You see, what happened in 2008 was the value of the collateral of the system started falling. And that was when the equity market starts falling. The real estate market was the real one. That was huge amounts of collateral with massive amounts of borrowing. The collateral falls, the borrowing becomes unsustainable, the whole system imploded. Now, the banking system itself was record leveraged. And what happened was this complete meltdown of the global financial system.
The sudden surge in birth rate and global population in the 1950s established the baby boomer generation as the dominant demographic, as Raoul explained. Because of the sheer size of this demographic, they shaped the narrative. Even today, baby boomers own more than half of the wealth in the US, and they currently hold the majority of assets. Unfortunately, due to the globalization of the US and access to cheap labor, baby boomers were forced to take loans to purchase these assets. By 2008, the system had reached a breaking point and was due for a reset. But instead of a crash, the economy rebounded in about a year. Raoul discusses how this was accomplished and what it means going forward. Sit back as we bring you more clips from the interview.
And looking back now, I now think that this really was the 1929 moment. But it didn't turn into 1929. And there was a reason for that. Is we had Bernanke at the Fed. And Bernanke had an understanding of what went wrong in 1929. And he had one special trick up his sleeve, which was the use of the balance sheet of the central banks to deflate the value of money itself. And so therefore asset prices optically rose. So that's the denominator effect you've heard me talk so much about. All the central banks agreed pretty much around the same period of time to start printing money, debasing all of fiat currency. Asset prices ripped. Well, guess what? The collateral of the system is now saved. So they save the system via this particular mechanism. Now, these are optics. They're not reality. They're optics. And I've spoken before, if you divide any of the assets since 2008 by the Fed balance sheet or global total liquidity or any one of these measures, they've gone nowhere. You see, we've had no real growth. 2008, yes, we understand that it broke, but it broke in many more ways. We hit something called peak fiat, and that's Geordie's thesis that I've stolen from him, but it really encapsulates what I'm talking about. That whole fiat currency debt-driven bubble regime died in 2008, and GDP globally fell. The trend rate of GDP growth ratcheted lower and never rose. But you see, more things happened after 2008 that people aren't really aware of. For example, the dollar has been rising since then. Why? Because the dollar is the global reserve currency, most of the global debts are in dollars, and there's a shortage of global dollars, and there has been since 2008, and really exacerbated by the time we got to the European financial crisis. So there's a shortage of dollars, there's a shortage of global lenders because of Basel III and the agreements with the banking system, so the dollar rises.
Ben Bernanke had an understanding of debt, demographics, and the impact of these things on the financial system. And so, as a response to the 2008 financial crisis, he decided to print more money. This act had the effect of sending the value of assets optically higher in that since dollars were worth less, assets became more valuable. This allowed the burden of the 2008 crisis that should have been borne by the asset-owning baby boomers to be spread out across all demographics, and arguably more on generations with little to no hard assets. But there's more. Let's head back in, as Raoul discusses what 2008 meant beyond the increase in dollar value relative to other currencies.
More importantly, when we look at global equity markets in dollar terms, they haven't gone up. See, here's the MSCI World. It basically hasn't gone up since 2008. When we look at, let's say, a country like Spain in Europe, Spanish stock market in dollars hasn't gone up. Italy, dollars, hasn't gone up. The Euro stocks in dollars hasn't really gone up. The FTSE in dollars hasn't really gone up. MSCI emerging markets haven't gone up. They've gone nowhere since 2008 in dollar terms. And the same with Shanghai. So the Chinese equity market or the Bloomberg commodity market peaked back then. There's only a few markets that have outperformed this. And those are the ones that I've talked about in the past. Those were technology, crypto. You could argue India as well because it's different demographic cycle. But not only did equity markets peak in 2008, but we also peaked in total debts. So really what we've seen is debt market has peaked. The US debt market peaked in the pandemic. We had that extra spike, but really it peaked a while ago. And I've talked about this before, and I'll come onto this in a bit, is the debt growth now is really just offsetting the interest payments. And it's all around trend rate of GDP growth. So therefore debt is not growing faster than trend rate of GDP growth, really, because it's the missing trend rate of GDP growth that goes into paying the interest payments, and the interest payments are where the debt growth is. Those are the deficits that we see. The US central bank has essentially monetized the interest payments on the debt, because if the government's 100% of GDP in debt and the private sector is 100% of GDP in debt, just to give you easy maths, it's actually worse than that, then the private sector with interest rates at, let's call it 2%, that's 100% of GDP growth to fund the interest payments. So who pays the government debt growth? And right now we've got interest rates too high and GDP growth is not high enough to service them. So over time, we will see some action there by central banks as they have to lower the cost of the interest payments. Because if not, it keeps compounding on the balance sheet. It keeps compounding and eventually lose control of the bond market and they have to impose yield curve control, or they have to print more money. Both are actually the same mechanism. They're just different ways of printing money. So that is where we are with the debt market. So it's kind of f***ed us there. So we've now been because asset prices are rising and we can't borrow money to even get into the property market, but they're also becoming unaffordable because our wages never went up. Okay, so those are the two key reasons why we're f***ed.
In this insightful interview, Raoul has explained the full impact of 2008. While the dollar value of assets has been on the rise since 2008, the true value of these assets has remained flat. Raoul, unlike most other experts, does not believe we'll ever have a massive crash akin to 1929. Instead, in place of such a crash, currency will continue to be slowly debased. Raoul explains that because of this, we're doubly f***ed. He expects AI, blockchain, and other emerging technologies to eventually increase productivity and eventually save us from this mess. But he doesn't expect anything to start till 2030, and it's a long way till then. In that time, he expects that we'll continue to experience 2008 moments. What do you think about Raoul's insightful analysis and warning? To see the latest in crypto news, watch this video here.